macroeconomic accounting. Uh, the outline for the presentation will be as follows. We will first talk about the basic concepts of construction measurement, including some perspectives from the SNA compilation and then BOP compilation. Following from that, we'll be taking on some case studies on the compilation of construction statistics, and finally discussing the analytical framing and uses of construction statistics. So starting with the definition of construction, there is a spectrum of definition in the economic literature depending on the point of analysis. On a more liberal framing of construction, it is seen as an economic activity that involves the entire construction process, that is, from producing the raw materials and providing professional services like design, etc., to the actual physical site. And therefore, according to this view, sees production as crossing through all three kinds of economic activities. That is, primary activities, which would include the extraction of natural resources, the secondary sector, which includes the manufacture of building materials and components, and the transformation into of the materials into finished buildings and structures. Finally, the tertiary sector, which would include the provision of consultancy services such as project management, design, and structural engineering. At the other extreme, on the other side of the spectrum, is the definition that construction only covers the last stage of the construction process, which is basically the physical work carried out on the production side. This definition is adopted by the International Standard Industrial Classification, and according to this classification, project management for construction, architectural and engineering activities, and the manufacture of building materials are listed under different categories other than construction. This manner of classification is considered convenient for statistical purposes, and we'd like you to note that in statistical compilation, more specific activity has to be identified primarily to avoid the double counting by ensuring exclusivity of defining the activity. Finally, the third approach that we call the Goldilocks approach, or the middle path, is the approach which contextualizes construction as the production process of the built environment, including various activities from conception through design to execution. As such, the construction industry encompasses all firms or organizations who are professionally engaged in the construction process, and from those providing consultancy services in the planning, designing, supervisory, managerial services, etc., to those carrying out execution work on site, which would include the general contractors and builders. So based on this sort of spectrum of definition, we can also see that mirrored in various classifications, starting with the central product classification, in which the sector is taken as construction and construction services, whereas we look at construction breaking down into subsectors of buildings and civil engineering works, and the other category being construction services as part of the main category. Whereas, according to the CPA 2008 statistical classification of products by activities, this category is called construction and construction works. And it is further broken down into three subcategories, which are buildings and building construction works, construction and construction works for civil engineering, and the third one being specialized construction works. Another useful concept to understand to look at construction measurement is to look at the various classes of construction. So there are two categories basically, new construction and repairs and maintenance. New construction refers to the site preparation for and construction of entirely new structures and or significant extensions to other structures. This is further classified into new construction of residential buildings and non-residential buildings, as well as other construction. The second category, however, is the repairs and maintenance category, which includes all construction work that is not included in new construction. And it's further important to break this down into capital repairs. These are repairs that extend the economic life or productivity of existing structures, and the non-capital repairs, which are merely the repairs that are done to prevent normal deterioration of existing structures. Next concept useful to understand is the value added in construction, uh, which refers to the gross output value at producers' prices less the value of all industries' current purchases from other enterprises. So all industries' current purchases from other enterprises are basically excluded, which include the value of input materials and components, cost of hiring plants, cost of goods sold in the same condition, legal and other professional fees, payments made for repair and maintenance, etc. It's also interesting to know that if we look at the value added to output ratios of the construction industry, in most developing countries, it's seen that they were higher than that of the manufacturing sector as well, particularly in the period of 1970 to 80. In fact, in some of the countries, the ratios of the construction industry could be as high as 60%, according to a World Bank report. In the context of our work, it is useful to look at this from the perspective of the supply and use framework as well. So on the supply side, here output refers to the construction output for market production, as well as output for own final use, which is basically own account production, any construction that is being done for own use. The second component on the supply side is, of course, the imports, which refers to the construction work for residents by non-resident construction enterprises. The goods and services, which also includes the goods and services that are acquired for construction abroad. Now, for the components on the use side, IC here refers to the minor repairs by industries. Final consumption expenditure comprises of the minor repairs by households, government, and MPIsh. Next, there is GCF, referring to the gross fixed capital formation or changes in inventories, something we'll be discussing a few slides from now. And finally, there is exports, referring to the construction work for non-residents. For the time being, we will isolate the imports and exports and revisit them in the BOP discussion, which would mean that our equation without the imports and exports in picture tells us that the construction output that is produced for final use comprises of A, the minor repairs by industries, uh, B, by households, government, and PISH, and C, the GCF or the gross capital formation. As is the nature of construction activity, which may take years to get completed, in the interim, the output is measured as work in progress, which is basically following the accrual basis of accounting. Here, we'd like to distinguish between two scenarios, which become useful concepts to understand for the further concepts to follow. So the two scenarios are one where a contract of sale exists and one where it doesn't. So a contract of sale basically signifies that an agreement has been made between the construction company and the client or the purchaser. Uh, and the agreement is that a particular construction output will be bought by the client. And in such a scenario, that is, if a contract exists, during the construction period, it is recorded as the gross capital formation for the purchaser and not in the work in progress by the producer, because a sale agreement here has already been made at the outset. Now, once this construction is completed, the output will then be recorded as sale at the end of the recording period. The second scenario, which is the absence of a contract, such as when dwellings may be constructed based on, say, speculative demand, etc., the dwelling in question then remains in the inventory of the construction company till the time they are sold, and then it is recorded as an output. So the boundary line between those products that are retained in the economy and are used in the consumption and those products that are used for capital formation is therefore known as asset boundary. And based on this, we look at the gross fixed capital formation, which, like I mentioned, is recorded at the time of the ownership of the fixed asset, is transferred to the unit that intends to use them to produce for further production. And then there is the change in inventory, which is basically the work in progress or the finished products which are produced as output, but that remain unsold in the market. Now you'll see up on the screen this useful sort of a cheat sheet that will help us understand how the construction can be classified as gross capital formation, since not all construction that happens is seen as an increase in investment or an increase in physical capital. So to distinguish that, we bring in the concept of, again, the developer or the person constructing the output, as well as the purchaser or the one being the final owner of the output. And we also look at how the intention to sell the asset and the timing of it comes into play. So the first scenario is that the developer intends to sell the asset upon finalization, but a contract of sale with the purchaser does not exist. So here the operating word is that there is no contract at the outset. In this scenario, we will count this as an inventory of work in progress itself. In the second scenario, the developer intends to sell the asset upon finalization, but has concluded a contract of sale with the final user. So since this contract is in place, this becomes GFCF for the developer's customer or the client or the purchaser who will be buying it. The third category is the developer is if the developer intends to exploit the asset for rental income or for own use. For example, if they're building a commercial property and giving it out for rent to shopkeepers, and they're building it out themselves, then this becomes the gross fixed capital formation of the developer itself. The fourth category is if the contractor and developer are the same unit. So the contractor could be anyone who's hired by the developer to actually carry out the construction process. In the scenario that they are the same unit, that is, the developer himself or herself is constructing the output, and this work is undertaken without a contract. In such a scenario, again, we will do what we do in the case of absence of a contract, and we count this as an inventory of work in progress. The fifth category, however, is when the contractor and developer are indeed the same unit, but they have a contract in place under which they have taken this work. And in such a scenario, this becomes the GFCF recorded in the contractor's customers accounts that way. Coming on to the other concepts of national account, in the context of construction, we look at intermediate consumption and final consumption expenditure. So here we look at the minor repairs and maintenance that comes into place for various construction assets or buildings, etc. So all construction output that fall out of the boundary of the asset boundary criterion, in fact, fall under the minor repairs and maintenance category. If this is consumed by industries, that is for further production, then this is counted as intermediate consumption. However, if it's consumed as a final use, then depending on who uses it, it can be either in households, government, or NPISH category. We also look at the statistical infrastructure that is recommended for the construction statistics to be thorough, complete, and robust, for which it is useful to understand what really is the information from construction statistics telling us. There are two broad uses, two major significant uses. One is that it helps to understand the level and significance of the capital formation by various sectors that are served by the industry. And secondly, it also helps us understand the organization structure and productivity of the industry. These statistics are captured mainly by business surveys or household surveys. We'll cover the details of it in a couple of slides later. And at this stage, various countries can be at various stages of development of construction statistics. There are cases where countries are on phase 0 or even in the first stage of implementation. It's also interesting to know as a fun fact that in 1997, the United Nations published recommendations on the reconciliation of these statistics across industries. We will be covering some of the recommendations very briefly in the slides to follow. So basically, yeah, in this slide. So here, according to the international recommendation for construction statistics, when looking at data gathering, the idea is to go back to the basics and basically understand the four classes of respondents. That is the four classes of units in the construction industry, and to see how data gathering will differ by each kind of unit that we're looking at. The first category is an establishment type unit, and which is used in the register-based surveys of the construction industry. So these are units particularly within the construction industry, and hence it becomes easier to bring them in a register-based framework. The second category is an establishment type unit that is used in register-based surveys of units carrying out own account construction, but whose main activity is not considered to be construction. So the difference between the first and second category is that in the second category comes those units which are carrying out production, but that's only for their own account, and they are not otherwise considered as having construction as their main activity. The third category is recognizable construction projects found in area samples, but those that don't get included in the business register. The final category is the own account construction that is done by households, which are enumerated in area sample of households. So the international recommendation here is to have a categorization like this for the classes of respondents, for which data can be then collected in more detail. So a fully developed statistical infrastructure for construction measurement would then need to cover these three kinds of very important data inputs. The first being the systematically maintained business register. This defines links, classifies various business enterprises, legal entities, kind of activity units, establishments, and so forth, and covers a substantial portion of construction output. The second is a system of annual or periodic comprehensive industry service, which will cover all construction activity and include own account construction by establishments that are not classified to construction. It will include those as well. The third is basically having ongoing household survey activity that is based on national area sample and managed usually through regional offices and utilizing more or less permanent staff or trained enumerators. So with these three sort of varying frequency based um, data sources, the hope is that it will lead to a fully developed statistical infrastructure for construction. But then, of course, there is always the possibility that there is a huge absence of the construction statistics, something that may be relatable to the work that we are doing in some of the Pacific countries, let's say. So in such instances, then it becomes important to get a little creative and see how the data gap can be filled. One method is that to measure output as its components, which would be the intermediate consumption and gross value added, wherein intermediate consumption will basically come from the data on domestic production, import, and export of raw materials. The gross value added, however, will come from employment and average wage of the industry, assumptions in the gross profit of the construction enterprises, etc. So this is basically an overview of the construction statistics when looking at it from the SNA compilation perspective. We'll now have Dean walk us through a review of the BOP perspective for the construction sector.
Yeah, thanks, Sam. So I'll take it from here. Okay. I'll just assume that my screen is visible and I'm audible. Right. So now that Sam has walked us through the national account, let's now turn our attention to how construction is manifested in the external accounts. So, with respect to the time of recording, it's still on an accrual basis of accounting, such that payment may be made upfront at the end or as progress, but the recording should be at the time in which the service is delivered. So the data source, the main data source, not only for construction but for services between residents and non-residents, is the statistics on international trade in services. It uses conceptual framework consistent to the 2008 SNA, and this responds to the information needs related to the General Agreement on Trade in Services and other agreements. The classification scheme for the SITS is the extended balance of payment services classification. And the classification for services is mainly on a based, but it's transactor based for construction services. What this means is that for some, specifically for the national accounts perspective, construction might be classified under goods. At least that's what I've seen in some of the national accounts statistics published. But in a case of the BOP, it's it would be classified under services. Okay, let's now go to specifically the nuance of construction services compilation in the balance of payments. So as for the coverage, it covers the creation, so these are new works, renovation, repair, extension of fixed assets in the form of buildings, land improvements of an engineering nature, and other engineering constructions. So how we want to think about construction in the external accounts is to look at it in two ways. So the first picture that we have in mind is when you do construction abroad. So for instance, say you have a construction enterprise, a construction firm, who is commissioned to do a construction work in a different economic territory. So how are those transactions recorded? How are those transactions compiled in the BOP? So the construction work for non-residents, so for instance, a bridge, for instance, by resident enterprises in the compiling economy will be um, under construction credits. All the materials, say your cement, your steel bars, for instance, and so on and so forth, that are sourced from the host economy and from other different economic territories, this will be under debits. I'll explore more of this in the next slide on how we numerically illustrate these transactions. Mirroring that illustration, say for instance, you have a construction in your economic territory, and this is commissioned or done or carried out by a non-resident construction enterprise. How it is then recorded. So the credits, the construction services credits or the exports include all the goods and services provided to that specific project. So for instance, you're able to source your raw materials in the economic territory where the construction is being carried out, then that takes part as credits in the construction services. The debit recording for the construction services or the construction work for residents of the compound economy by non-resident construction enterprises. This is a mouthful, so let's do a numerical illustration of how that happens. So let's assume two territories. One is the Americas and one is Australasia. And a construction company agrees to build a bridge. So the company is coming from the Americas, and the bridge is being built in Australasia. Let's assume that the gross value of the construction is valued at 1,200 local currency units, um, of which goods acquired from the Americas are 250, goods and services acquired from Australasia are 100, and there are certain goods and services acquired in Europe and Africa valued at 200. In terms of wages, the Americas pay 300 local currency units from the wages coming from the non-resident construction firm, and that there are locally sourced employment in Australasia that's valued at 150 local currency units. In the balance of payments, from the perspective, sorry, From the perspective of the Americas, the gross value of construction abroad, 1,200, is credited here because it's the value of the project as being carried out. But how does this mirror the debits recording for this specific transaction? The 200 general merchandise that you see here is coming from the Europe and Africa transactions. Since these are out of scope, and since when you think about it, it's assumed to be imported, it would fall under general merchandise. The goods that were acquired in the Americas, this 250, does not appear anywhere in the BOP because the transaction happened between residents. So there's no transaction that are happening between residents and non-residents. Therefore, it's excluded as imports and exports. The 100 that we see here are the goods and services that are acquired in the economy where the structure is being built. So this is the 100. And this would fall under the construction services that are debited from Australasia. And the 150 debit that we see here are the wages that are locally sourced where the project is being carried out. So I hope that illustration is much clearer when we deal with construction transactions between residents and non-residents. Now, let's go to the case studies on the compilation of construction statistics. We narrowed this down to SNA compilation, and we narrowed it down to two countries. So for the Australian system of national accounts, they're sourcing their data from economic activity survey. So it's a counterpart of enterprise surveys of other reporting economies. So the information that you're getting from the economic activity survey are the output of the construction industry, the intermediate consumption on construction activities, as what Sanisha mentioned, that when it's a minor repair, you can also get information on that, the gross fixed capital formation on construction, and work in progress inventories. To supplement this survey, they also have engineering construction survey. So they do ask for this is used for the gross fixed capital formation on construction, and they're collecting information on engineering construction activity both by public and private sectors. So what the objective of the survey is to seek details on the value of various construction assets such as roads, highways, subdivisions, bridges, railways, tramways, and so on and so forth. Then lastly, they also have construction industry survey. So what's the goal of the survey is to measure the size and structure of the industry, to detail the income and expense, and to look at inter-industry comparison. The outputs of the survey is income from trade services, building and construction by nature of contract, contract income from trade services, inventories, assets and liabilities, employment total income, wages and salaries, and value added by geographic location. So you seek information on construction sub-industries, which include building construction businesses, non-building construction businesses, and construction trade service businesses. And it covers wide variety of construction assets. So this would include houses, other residential buildings, non-residential buildings, road and bridge construction, and other non-building construction. And an important variable that they're getting from this survey is whether the work is a new construction work, which then would end up as a gross fixed capital formation or inventories depending on the arrangement of the turnover of that structure, that property. Additions, alterations, and renovations depending on the classification. But I think Insofar as my knowledge is concerned, I think they're classifying this under the GFCF as well. And they're only covering repairs and maintenance for consumption expenditures. The second country case that we have compiled is the Philippine country case, where I personally got my hands dirty compiling construction statistics for the national accounts. So, what are the data sources for the construction in the Philippine national accounts? So, we have government administrative data on public construction. These are various sources coming from different agencies. You have the department or the Ministry of Budget and Management. You'd also get data from the department or the Ministry of Public Works and Highways, and so on and so forth. So what's being done is, depending on the time and the period of reporting, we reconcile several various data sources, various administrative data sources in a meaningful framework that is the system of national accounts. The second data source that we have is construction statistics from approved building permits. So this is very similar, and I think this is parallel to the construction industry survey of Australia, where you get information on residential and non-residential construction additions, alterations, and repairs. I just want to make a note in the construction statistics from approved building permits that these are volume measures. So what we're measuring here are the new construction as well as the floor area for construction. Later, we'll see how these volume measures translate to value measures. Then we also get information on consolidated public-private partnership on construction projects. Specialists might encounter public-private partnership projects for construction. In the case of the Philippines, where the investment is carried out by the private sector and the scheme is a build, operate, transfer, these investments are attributed to the private sector, to the corporations, because these are investments by private entities. They derive value from it before they turn it over to the government. At least that's how the public-private partnership scheme happens. Then lastly, as I mentioned a while ago, we translate the volume measures from the construction statistics from approved building permits into value by using construction raw materials wholesale price index. We also use other price indices to translate those volume measures into value measures. The classification of um, construction in the national accounts is not by asset type. So you have a GFCF matrix where your classification is on the row wise, you have the types of assets, and in the column wise, you have the industries and the final uses. But in the time series publication of the national accounts, it's not classified by assets, rather, it's classified by institutional sectors, namely the general government, the financial and non financial corporations, and the households and non-profit institutions serving households. And they also publish gross value added for their construction sector in the national accounts. Now, let's proceed to the analytical framing and uses of construction statistics. So, as what Sam mentioned a while ago, we can look at the construction activities um, into two main variables, right? So, one is the construction value added, where it is a component of the gross domestic product, and it measures the value added by construction firms to inputs from other parts of the economy to produce the gross construction output. So this includes the compensation of employees, the depreciation of fixed capital, the operating surplus, and the net taxes on production. The second metric that's very interesting is the gross construction output. So it is a component of the national investment, um, which is the gross capital formation. Um, it is the aggregate of construction works value added and the value of contributions from all other parts of the economy that produce construction works. A third metric is also important, but from the perspective of national accounts or from the perspective of macroeconomic accounting, it's not that useful. That is the contractor's value add and output. So it limits the metrics that I have mentioned from the perspective of the contractor, which already is included in these measures of construction statistics. It has a different use. I'm not really sure what that is for, but yeah, for some researchers, it's also important for them to zero in on the contractor's output and value add. Um, it is common but not universal in national accounts where there is a breakdown of construction output to provide data on residential, non-residential, and civil engineering work. Um, this is what the Philippines is doing. So the breakdown of the gross fixed capital formation is on the basis of who is the one who's investing. But depending on the decision on the use of construction statistics designed by the National Statistics Office, um, there might be variations on how they want to present output and gross fixed capital formation on construction. It is often not possible, however, to obtain reliable data on construction output by shade or pre-construction activities. Why is this the case? It's the case because these activities are already embedded in the activities of the contractors. So seldom do you see contractors isolating their work in trade construction or pre-construction activities. Normally, contractors do their work from start to finish, and they do subcontract if the work is has to be finished for given resources and given amount of time of the project. So, in terms of ISIC, while it's convenient analytically to break this down, functionally in real life, the data compilation, the data collection might be difficult given the nature of the construction industry. Um, yeah. Lastly, on the limitations of construction measurement, a survey in 2011 um, on behalf of the African Development Bank revealed that um, a high proportion of construction activities are carried out by the informal sector or undertaken by households. This is not really a problem because it might be covered in the statistical surveys. So it really is a practice for you to have an own account production of construction assets carried out by households, or it's highly likely, especially in developing economies, where the construction is an informal sector. The problem lies with how the national accounts is compiled, because first, in some cases, um, it's not really covered in their um, surveys. So, in some countries, only work by registered contractors is included in the national accounts. In others, it's included. So, when you look at comparability, it's difficult if the coverage is not consistent, and as much as possible, we want to be as comprehensive as possible when we cover these activities, not only for construction, but for other industries as well, with high informality or with a high household enterprise proportion to the total industry. So yeah, I'll leave the rest of the presentation to Sam.
Thank you, Dean. I'll just share my screen back. Mm. So now taking this a step further, we will discuss construction in the context of economic growth, something we hope would interest particularly our colleagues who work on the IO analysis. So we refer to the Harrod-Dormer model of economic growth here that states that net investment is necessary for the economy to grow. We distinguish between economic infrastructure and physical infrastructure. So investments in economic infrastructure are actually considered to be supplementing other physical capital. So, for example, a farmer may increase the total output of crops by investment in a new tractor, which is the physical capital here, but without adequate transport facilities, this extra product cannot be available in local commercial markets. And thus, his investment may not add anything to national food production. So, it is important to kind of see both economic infrastructure and physical capital as supplementary to each other. So, as a result, assuming there were only two products, product one and two, produced by the economy at a given technology level, increases in capital stock, which would mean both human and physical resources, would make it possible to shift the production possibility curve outward uniformly, as is shown in the graph on the slide. This is also possible because infrastructure can also raise productivity of other factors of production. I'll give an example here. That is, an installation of a new irrigation system can improve the quality of the farmland as well, and thus raise the productivity per hectare and shift the production possibility curve outward. So the higher productivity in turn then attracts more resources, that is more investments in production, which will further contribute to higher levels of output, profitability of production, income, as well as employment in these sectors. So the process of investment in physical capital stocks of an economy, including infrastructure, is therefore measured by the gross fixed capital formation. And when we talk of GFCF by construction, we refer to the total value of additions in construction made within a year, which includes both new construction as well as capital alterations. So now talking about the concept of backward linkages and later on forward linkages as we go ahead, since large quantities of building materials and components are purchased from a large number of supply industries, an expansion of the construction industry can therefore stimulate the expansion of these industries as well through backward linkages. And the impact can be significantly large here because much of the building materials can be provided by relatively unsophisticated labor intensive domestic resources, and by basic industries as well, such as cement and steel manufacturing, all of which are key raw materials in construction. Many output input analyses have in fact indicated at very strong backward linkages for this sector. Consequently, should the value added by construction, if that were to take in account the backward linkages, for example, the manufacturing of building materials, etc., then the value added from this sector can account for a considerable proportion in GDP. That is, if it were to take into account these linkages. Also, it is hence important to note that while imported materials are necessary in the short run, an economy needs to develop its local supply industries in the long run if it aims to increase value add, which can prove to be useful as we have explained through the backward linkages, strong backward linkages in this sector. As far as forward linkages are concerned, the indexes of forward linkages are relatively less extensive in the construction sector than backward linkages. However, in the absolute magnitude terms, the forward linkages itself can be very significant since the demand for construction output is a derived demand from all other sectors of the economy because all other sectors are in some way or the other dependent on infrastructure and construction output. So as a result, how these sectors react to the change in the level of construction and vice versa will ultimately affect the economy. The strong linkages stem from the fact that all other sectors of the economy are using the flow of services that infrastructure generates, which in turn then leads to growth in the production of other economic sectors. And this happens in two ways. First way is through the reduction in the cost of the intermediate input. from infrastructure such as transport, water, electricity. So as the cost of it um, reduces, it can lead to growth in the production. Um, and Second is through the increase in the productivity of other factors of production, like we talked about before. As a result, the supply of infrastructure services can therefore highly raise the productivity of production, level of returns, output, income, employment of other sectors as well. Here are some examples up on the slide of studies that were done, particularly talking of the agricultural output here, interestingly, um, covering various sectors. For example, roads and electricity were found to have strong positive effect on agricultural output. In one of the studies, the spending on transport and communication services was a significant determinant in across a bunch of countries in another study. And in the third study, the public goods and services, including infrastructure, were also seen as key determinants of agricultural output. Uh, Again, when looking at forward linkages, we also have to look at infrastructure as a major source of business expense. And what happens is that there are multiple economic costs that can be associated if there is an unreliable delivery in the infrastructure services, and lack of access to infrastructure services can therefore result in multiple economic costs, such as direct cost of production delay, loss of perishable raw material, output cost of underutilization of capacity, etc. Infrastructure has also become one of the determinants of international competitiveness, as we know, which directly impacts the ability of the country to engage in international trade and to compete for direct foreign investments. So to conclude, while the crucial role of construction's supply capacity in raising other sectors' output has been established, there is very little that is known about the reverse flow of influence. That is how the adaptive capacities of other economic sectors can affect the construction sector. The final On the final slide, we'll bring in a discussion on employment in the context of this sector. The contribution of construction in the economy has also been measured by the construction employment as a share of the total employment. And numerous data have shown that there have been dramatic increases in construction employment in most developing countries, particularly due to the abundance of unskilled labor. The fact that the construction industry is more labor intensive than many other industries, especially when seen relative to manufacturing, this makes this industry a traditional focus of employment generation policy in many countries through labor intensive public work projects. The labor created in these projects, in turn, then spends income from the employment on other locally produced goods and services, thereby stimulating the demand of rest of the economy, and that is the multiplier effect that we talk about. So as a result, during periods of slack demand and high unemployment rate, infrastructural construction projects funded by the government are often implemented as counter-cyclical instruments. So we've seen that in the 2008 economic crisis, many countries relied considerably on construction spending to spur their employment and jumpstart the economy. And for many countries around the world as well, they have included construction of infrastructure such as railways, highways, airports, power grids, etc., as part of their fiscal stimulus packages. So, with this discussion, we will bring an end to the presentation today. We are open to questions if there are any.